This is a podcast from the Business Times.
Wall Street ended the session higher overnight, driven by a strong rally in chip stocks after Microsoft's upbeat earnings outlook reinforced confidence in the AI story. But the picture wasn't entirely positive. Meta tumbled after reporting a major decline in its free cash flow, highlighting growing investor concerns over the cost of AI investment. In Asia, South Korea's Kospi jumped more than 14% at the open today, although the benchmark's record volatility this week has taken a particularly heavy toll on leveraged retail investors. Meanwhile, Japanese authorities stepped in to support the yen after the Fed's decision to hold rates yesterday, keeping currency markets firmly in focus. It's been another eventful week for investors. So how should markets be positioned for the week ahead? Joining us today is our expert to help make sense of it all. Welcome back to Market Focus Weekly. I'm Claressa Monteiro, standing in for the vacationing Howie Lim. It's Friday, July 31st, 2026. I'm joined by Martin Hennecke, Head of Asia and Middle East Investment Advisory at St. James's Place. Martin, let's take a step back and look at this week's earnings from the major tech companies. Let's address the AI capex first. How sustainable do you think a current AI investment boom is?
It's a real pleasure, first of all, to be on the show, Claressa. Thanks for having me. And yeah, it has been a very eventful week. On the one hand, has there been, in some ways, too much short-term greed and speculation? Yes, absolutely. Is there still a risk of sharp correction in some areas? I would also say yes, absolutely. On the other hand, though, it would be too simple to just categorize it all as a bubble, because you have got very strong earnings of a lot of good companies in this space. And in fact, if you assume that the current profits and conditions don't change just based on the latest profit numbers, the valuations aren't actually overly commanding. The question is probably then more, what's the outlook? What's the competition going to look like that's coming up from China? What's the effect on that, et cetera, et cetera? So 3 points I'd like to make. Number one, diversify. Don't just put everything into tech and everything into AI. Diversify, because when you're looking at longer term valuation pictures, you see that value stocks versus growth stocks are more or less at the lowest point since 1999. So 27-year low of value versus growth, and small caps are relatively underpriced as well. So I would definitely make sure in your portfolio you balance any growth exposure with value. That's number one. The second thing is, be very careful with leverage. Only invest monies that you can spare for the longer term. We have seen a lot of investors in Korea in tears recently with the leverage ETFs gone very wrong. And that's sort of a third warning in terms of how to invest. Be very careful with any type of very fancy products. Only invest free monies for the longer term and stay diversified.
So basically what you're saying is go back to the old school thinking of only invest money you can afford to lose.
Yes, absolutely. I mean, I see time and time again people falling into this trap. Never forget the old school and just try to play it safe.
All right, now let's talk about AI-driven investments, which is maybe some of what you're talking about. Is it going to be complicating the inflation outlook and influencing central bank policy, you think?
I don't actually think that AI will be necessarily the major influencing factor on inflation and central bank policy. I would like to highlight some other factors, though, that I think have been very much overlooked. Let me start with the more obvious one first. The geopolitical conflicts, right? You see the Iran war and the effects on that. There's still the Ukraine war too, which people have forgotten to some extent. So that is a risk. It also results often in less trade, geopolitical tension, and more tariffs, etc., all of which is inflationary. There are two other factors. One is China is just by far the dominant exporter of goods to the world. China had deflation for the last 2.5, 3 years in terms of producer prices. That has turned into inflation now. We have 4.1% producer prices. which means that prices won't get cheaper. And you see pressure now on input costs, and companies are passing those through to their end clients. So that's one pressure. And perhaps the biggest overlooked one is very high sovereign debt levels. So you have Fitch rating agency coming out warning that it's worse than people think, basically. They project the US budget deficit as 7.8% this year. Now, if that doesn't mean something to you, well, I'm from Germany. I very much remember when Germany joined the single currency Eurozone, there was a rule that no country could have a budget deficit above 3% because anything above it was considered to be unsustainable. If you have a very, very high sovereign debt loads, central banks are under tremendous pressure not to be blamed for triggering a debt crisis because the interest burden has been rising significantly. And so they might be boxed in. If they raise interest rates a lot to stop the inflation, which they might want to do, that also means the governments have to pay much higher interest. And I think there's a risk that they can't do it and they need inflation being higher than interest rates to wiggle out of that debt trap. And for investors, that also means not investing has a risk too. If you're all in cash, the risk of negative real interest rates might be rising as a result of these very, very high sovereign debt loans of the Western countries. So you have to be conscious of that. And for anyone who can tolerate some degree of volatility, then it's good to allocate to at least some investments that are more inflation-proof than others. And super briefly, what is that? First thing people often think of is commodities, but also property is principally an inflation-proof asset, of course, and equities too, as companies do tend to pass through the rising input costs to their clients in terms of higher prices they charge for their customers. And that's one important thing of why we still like exposure to equities as well, longer term. But again, be balanced to areas that have not seen so strong gains where there's good value to it, might be more resilient that way.
On your point on central banks, I want to come back to that, but I want to also look at the recent correction in memory stocks and ask if you think we're approaching the peak of memory chip upcycle, or is this just a reset?
It's really, really hard to say. When you're looking at some of those recent numbers and reports coming from the large Korean companies, it would seem that there's still tremendous pressure and tremendous shortage of those chips at the current time and maybe going into next year as well. Now, in how far that's going to be eased by, say, production being ramped up by some of those same companies or competition coming up from China, etc., is really quite hard to say, which is why we take a middle ground. You don't have to be all AI or non-AI, take a measured approach, but also look very much at individual companies as well and don't necessarily focus on thematic investment. Whenever clients ask us for any thematic investment themes, it's usually the one that's most popular in the media, has received massive attention, and where due diligence goes out of the window. So if you want me to give one specific example, I think the Chinese IPOs recently definitely has been a bit of over enthusiasm. I'm not judging on the specific prospect of individual companies, but whenever we have seen such kind of levels of uncritical enthusiasm in China before in the previous years, that has often led to steep market corrections and in tears for many investors.
All right, let's talk about what you brought up, hostilities in the Middle East. How well prepared do you think Asia is for another sustained oil price shock? And which markets would be most exposed?
Yes, that's a great question. It's really time not to be complacent about it, as we see quite a number of countries being somewhat dependent on energy inputs, and not even just only the obvious. But let's just mention the obvious ones: Japan, Korea, India, starting really to be very concerned about the situation. But of course, if some of those countries earn a lot of money from other areas, then they can just buy energy at higher prices from other sources. But overall, I would say for someone who doesn't have a very high tolerance, spreading it to different assets rather than just only equities could be really important as well. For example, fixed interest or inflation-linked fixed interest are asset classes that didn't do well at all in the last couple of years, but yields have risen. And so that could also be a good diversifier to look at, just to hedge bets on these areas. And maybe inflation-linked bonds would potentially offer some protection from such effects that rising oil prices could cause, both in terms of equity market correction risks, because people might rediscover bonds as a safe haven, plus you have some inflation protection at the same time for exactly that scenario.
All right, stay with us as we break down the opportunities emerging across Asia, the next phase of the AI trade, and Japan's move to support the yen.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. It's Market Focus Weekly. We're speaking to Martin Hennecke, Head of Asia and Middle East Investment Advisory at St. James's Place. Martin, let's continue with our conversation on Asia. Should investors be reassessing their exposure to Asia's tech names, or do you still see attractive long-term opportunities?
Well, for anyone who is overexposed in portfolios and very highly exposed to tech, now whether that is US tech or tech across emerging markets, it is really, really important to balance across sectors now. Highlighted previously, when you look at some other market segments that have been much less in the headline, firstly, you can look at some indirect beneficiaries, but even the indirect beneficiaries have been recognized at last. And so some of the other areas that have absolutely nothing to do with AI, they might be really good picks. I'll highlight one area like local consumption. Local consumer stocks in emerging market, they are trading at multi-year lows versus other sectors. In China, people just assume that consumption is completely dead, and it has, of course, been weak. But sometimes when you are at the maximum pessimism and maximum weakness, stocks can front run potential changes. There's been a study done looking at correlation of economic growth and stock market returns, and it actually found a slight inverse correlation. And that could be because when everyone is pessimistic, stocks are already priced very low accordingly and could have upside potential. Or when governments get desperate because of economic weakness, they might then come out with stimulus again. And in China, that could very well happen. We have just seen this morning actually pretty weak PMI manufacturing numbers, 49.2, and yet government fiscal revenues have actually been very strong. They're up 4.7% in the first half of 2026 in China, and household savings are very, very big as well. So I wouldn't be surprised if China was finally rolling out a bit more stimulus, and if the AI boom might lead to some recovery of confidence as it is being combined with the stimulus. That gives some potential maybe for other sectors to also finally come round and see better returns than they have seen over the last 17 odd years.
To your point, that was the thinking a few years ago on China's property sector, but it hasn't really come back yet.
Yeah, absolutely. The property sector is still very weak. To be fair, when you look at rental yields, they were very, very low to start with. And so that was never a very strong starting point there. But then you can look at, is there a slight stabilization or not? And what does the government think? You never know when things turn around. And I'm not saying at all go all into property stocks or all into China consumption stocks or sell out all of anything that has to do with exports. And exports have been very strong. But we do see from bottom-up valuation that there are a lot of sectors that people don't look at. For example, shipping companies, other consumer goods that received lots and lots of attention many years back. And everybody's saying, oh, China consumer, China consumer. Everyone jumps on that story. Now it's down. Valuations are really discounted and nobody is looking at it. It's always easy to say, oh, it's not been doing well. But sometimes those most depressed things might come back. Korea is also an example of a market that people didn't love for a long time. A lot of good tech companies were there, but the valuations didn't go up. So people say, well, even they do well, it doesn't really work, right? But when you look at the fundamentals and the potential for turnaround, if it's there, you might want to look at just moving into it, even if nobody else thinks there's going to be any change.
All right, let's move on to Japan. We saw the yen surge. Everyone, I think, suspected intervention by the authorities. Should we expect further yen strength from that?
Yeah, that's an interesting question. And we don't really know yet what exactly happened there. I would say two things. Firstly, historically speaking, the yen is very undervalued in purchasing power terms. If you go to Japan for a holiday, you'll also realize prices are, for most things, pretty low and a pretty good deal. What does it mean going forwards? Well, our preference, generally speaking, would be to allocate to equities there compared with bonds because yields are still not that high. And when you invest in companies, you have a bit of intrinsic protection against currency weakness just in case. Because as I mentioned earlier, companies can increase prices in line with inflation. So basically what's happening in Japan is you see inflation is still much higher than the interest rates, and savers are losing. A lot of savers in Japan are getting very, very nervous of losing the purchasing power by holding cash. And that is why some of them have looked at reallocating that to property, to equities. One last point I want to make there. Japan has a very high sovereign debt. And if they increase rates significantly, that could also trigger a debt crisis because interest cost is a very sensitive thing if you have so high government debt. And I think this is a scenario that may come to the global markets because the US and Europe also suffer very high debt loads, very high budget deficits, and there might be stuck in that same situation. And savers need to watch out for that risk of not doing anything, the purchasing power getting eaten up over time when you just allocate to cash or similar asset classes that don't provide inflation protection, if that makes sense.
Before I let you go, since we're talking about diversifying and making sure you're not overexposed within tech, for investors, could ASEAN markets become a bigger beneficiary of global capital flows beyond the AI trade?
I would say very, very possibly. It is very true that in many of the ASEAN markets, or in fact other emerging markets that are not necessarily so AI driven, they have been quite neglected. 2-3 years ago, we went overweight emerging markets versus the US. And this has now played out, but only to some extent the AI boom, but not exactly those areas and some of those countries that you just mentioned. I highlighted earlier the potential maybe in some local oriented companies, local consumer companies, etc. And I think if we see a mean reversion of values in those areas, some of the Asian countries might also become the beneficiaries. For us, though, we look at this from a bottom-up company perspective as well, rather than wanting to highlight any particular country from a macro perspective. In fact, many of the most successful companies that operate regionally or globally these days doesn't even really matter where they're necessarily listed.
Martin Hennecke, Head of Asia and Middle East Investment Advisory at St. James's Place. Thank you for joining us today.
A great pleasure. Thank you for having me, Claressa.
That's it for this week's Market Focus Weekly. Check in at the end of every trading day for updates on the biggest moves and news in Market Focus Daily. If you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.